Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew, and we're here on this conversation to take you through a primer of how to invest in fixed income. And this is specifically related to investments into mutual funds that in turn invest in government securities, that is, government bonds, and also other forms of debt that are issued by the government and corporate debt. So let me introduce my guests without further ado. We've got Devang Chow, who's a co-head of fixed income at Axis Mutual Fund. And we've also got Harshvardhan Roongta, who is a co-founder of Roongta Securities. Gentlemen, thank you so much for taking the time. I will start with you, Devang, just to give us a sense of where things stand right now. A lot of what happens in the fixed income market is dependent on monetary policy and where the RBI is fixing the rates, and also on the government's borrowing calendar. So where do we stand right now? What's the context?
So thanks. I think probably just to start with, if you look at the last 6 months, we've actually seen a lot of front loading of rate hikes everywhere. Not only, I think, Fed, you pick up Bank of England, you pick up ECB. I think Indian Central Bank has also done the same thing. The operative rate has moved in the last 6 months from 335 to now 650. Though the repo rate has moved from 4% to 590, actual movement in operative rates in Indian markets also close to 280, 290 odd basis. Our perspective is looking at the inflation, which is now, I think Governor also spoke in some conference last week, and we believe so that the inflation in India is showing a downward trajectory, though above RBI comfort zone, but I think probably the 7 handle or the near-term peak in inflation is behind us. What we look across from both growth, which is very strong still, and from a macro inflation perspective, which is a downward trajectory, we believe so RBI will continue with its rate hike. Fed will also continue with its rate hike, but incrementally the pace, the quantum of rate hikes will now be lower, as well as we are very much close to the terminal rates. Entire market in India is pricing in 6.5 to 675 kind of operative rate and or a repo rate, and be it swap curve, funded curve, GSEC, corporate bonds, I think is pricing in 6.5 plus of operative rate, and hence incrementally from here, even though we see a 35 basis increase in the December policy and 25 basis increase in the Feb policy, we expect market to remain quite range bound and don't expect any huge volatility.
So we'll come back and revisit that point in just a bit. What you're essentially saying is that you expect a 35 plus 25 basis point hike from this point on in the repo rate, but you don't anticipate a dramatic shift in the yields, which of course affect how a fixed income investor gets returns. But Harsh, coming to you on strategy. Now, a lot of people automatically gravitate towards the equity markets, especially in recent times, because that's where the returns are over the long period. But we've seen a substantial shift in the last couple of years, as Devang pointed, in the policy rates, and we're once again talking about better yields that people are getting in fixed income. There needs to be a balance, right? So how should you approach investing in fixed income products?
Well, Alex, you picked on a very valid point, because in the recent past, we've seen that a lot of investors have started moving towards equity for a simple reason, because they see returns over there. And the returns on the debt side, on the contrary, have been very subdued. And in fact, those who had invested into debt probably a year ago would be seeing a very, very a flattish or a negative return, all you may say. I mean, it may be flattish or very, very nominal return, because the yields have been going up. So that is a very natural phenomena. Now, if you talk on the broader level, on the macro level, if you're talking as an investor, what an investor needs from his money. Okay, so that you need to understand. One is, of course, liquidity. When you need the money, you should get it. You need safety of capital. I mean, that one portion of your money, you need to keep it in such a format that you don't, it's not volatile as much as equity could be. And third, of course, I mean, you need return. Now, if you were to combine this together and create a portfolio, so some assets will be liquid in nature, some will not be, some will be volatile, while some will not be, etc. Liquidity, etc. You need to have a balance of both, because your needs are not only long term. You may have emergencies which may come up. You may have some short term goals which you need to fulfill, which cannot be fulfilled with equity as an asset class. I mean, you cannot depend on it. Okay, if the markets are doing well, it is liquid asset. If the markets are at a peak, you may always sell it off. But that's not an argument that you'll give at the planning time, right? At the time when you're planning, you cannot bank on a good market scenario after 6 months or 1 year if you need money. So there has to be a balance. And diversification is the only way you can mitigate risk. So you need to have a very thought out process of how much you're going to put into debt and how much into equity. And that is called asset allocation.
So to that point, and I know that you are a proponent of having an overarching portfolio-based approach to saying that this is my allocation towards equity, this is my allocation towards fixed income. I will also have possibly a little gold. But how do you get into deciding what percentages you need to have so that you know that you have money for this particular goal that you have maybe in 3 years, this goal that is in 5 years, 7 years, etc.?
Yeah, so the asset allocation strategy, I mean the allocation percentages, if you were to decide, there are two ways. One is that you go and customize it to yourself, wherein you put in what are your goals specifically, what is the time horizon that you have. Like if there are some goals which are say 10, 20 years away, then equity allocation will be higher. If you have goals which are probably near term, you need money after 1 or 2 years, and that's your primary, a major responsibility. Like you have a higher education fees to pay. Now that then your allocation will be different because that's your first goal approaching in the next 1 or 2 years. Your debt allocation will be higher. So one is that you go into a detailed planning process. You put in all those factors, which is time, your risk appetite, etc., and you draw up an asset allocation plan. Alternatively, if you do not have access to that kind of information or a professional advisor whom you can talk to, there are thumb rules. I mean, it just simply says that if you're 30 years of age, you have 30% in debt. If you're 40 years of age, you have 40% in debt. So those thumb rules can be applied in case you do not have any other option of going into the detailed planning part of it. However, the first element that I said, that you need to evaluate everything in detail and then design your asset allocation plan. In case you don't have, then you may probably rely on the thumb rules.
So, gentlemen, interesting, right? Your approach to personal finance and investing can be as simple or complicated as you choose to make it. Devang, in a conversation we were having very recently, you were talking about a carry approach that one can take up in the near term based on where yields are likely to move, or based on how yields are behaving right now. Could you explain that? Because I think a lot of people are thinking about whether it makes sense to lock in these yields at what, 7.3, 7.4 for the 10-year, because it's attractive at this point. Should you lock it in right now? Because starting maturity funds are available that are open-ended and that allow you to take that kind of exposure.
So, Alex, I completely agree that today now a part of your allocation has to be in fixed income, because what we believe, so absolute yields in fixed income have significantly increased. Like I think Harsh pointed out a very fair point that last 2 years fixed income returns have been very, very subdued. It's been around 4.5%. But incrementally, the YTM of these products, and first of all, as I told you, the peak is nearby. When it comes to terminal repo rates, when it comes to the entire fixed income market sell-off, we don't expect a major sell-off in bond yields from here on. We have seen a 300 basis increase in rates in the last 6 months. So what is our view is, if you pick up the 1 year segment also today, it is giving you around 7.25, 7.5. You pick up 10 year also, it is 7.5. The curve is quite flat. Still, uncertainty prevails on certain aspects, which is where medium-term inflation is heading towards, how oil is settling, and probably how is the external sector, because people are still worried about the Russia-Ukraine crisis. We are not to the end to it. So what we believe at this point of time is that it is very, very important for first to investors to transit into fixed income, probably by the short end of the curve, which is the 1 to 3 year segment, which makes a lot of sense at this point of time. And the curve being very, very flat, still uncertainty prevailing on inflation, I would probably advise clients to stick around with 1 to 3 years, lock in the carry, use target maturity funds or active short-term funds as an allocation, and which would make great sense for the next 12 to 18 months from fixed income investment.
Fantastic. I think that broadly covers the basics as well as the strategy point of view. Gentlemen, thank you so much as always for taking the time, and pleasure speaking with you on BQ Prime.